Welcome, my favorite federal employee. Being debt-free is a great feeling, isn't it? As someone who has had 54 houses, 44 paid off, and 10 with mortgage, I can tell you personally, I always worried about the 10 that had mortgages. I'm really glad that you found our channel. I'm a son of a CSRS employee and founder of SWAN Capital, a total wealth management company where we have an estate planning attorney, CPA, and financial planners under one roof. And so many federal employees ask me from time to time, do you think I should take out a large sum from my TSP to pay off my home mortgage? And that's what we're going to answer today.
Man, I'm exhausted. 54 houses? Are you crazy?
I'm glad I'm down to 9 houses. I finally sold all of those, Bruce, so I'm excited about having less houses.
I've got 3 years to go, and then mine's paid off. All right. Have you come across this, the instance of those federal employees who said, I want to pay off my home using my TSP? Do you have that come up very often?
We do. You know, a lot of times families say, hey, I have this mortgage over my head and I'm going to be on fixed income with my FERS pension, my Social Security, and I need less bills, of course, so that I can retire. And so if I could just get this off my back, this, big mortgage, then I think I could retire and afford the lifestyle that I want.
All right. So is there a biggest advantage to using your TSP to pay off your home?
Yeah, I mean, if you pull money out of your TSP, of course, it would eliminate one of the largest payment that you have before taxes for most retirees, but it creates this really nice sense of financial independence and security. It provides you the peace of mind knowing that the house is truly mine, and it could save you thousands of dollars in interest over the life of the loan and the life of owning that property.
All right, so let's go juxtapose. What's the downside of using your TSP to pay off your home?
Yeah, as much as it's great to have that feeling of no debt going into retirement, your home is never truly paid off. You will always have property taxes, you'll always have home insurance, and maintenance costs continue. So the feeling that it's paid off or you'll never have any more bills related to your home is just not true. Also, if you withdraw a large sum from your TSP, you're going to face a major tax hit. And this is what you have to understand is when you take money from TSP, they're going to maybe withhold 20% as a federal tax withholding, but you'll still have taxes to pay at the state level if you live in one of the states that has state taxes. You'll have to also understand that depending on your income, you may have only withheld 20% taxes, but you might owe 22 or 24% taxes. Plus, you're losing investment growth potential since home equity doesn't earn a return like your TSP. And people say, no, Andrew, my home appreciates in value. Your home equity and the market value of your home are two separate things. The home equity that you have technically does not earn a return. And so selling a house is oftentimes easier when you need to do it, not when you want to do it. And so it's really important to understand that by having mortgage debt on a home is sometimes actually an okay thing going into retirement because I have my debt connected to an appreciating asset. It's different if we were talking about auto loans or student loan debt or a consumer credit line, a personal loan. Those are tied to depreciating assets. But if I have my home tied to an appreciating asset, I can feel okay as long as that interest rate is below 5%.
All right, so if we have some folks watching along with us and they say, I just want to do it, but there's simple and there's compound interest. Can you explain the difference if making this type of a decision is on somebody's plate?
Yeah, I mean, your mortgage is a simple interest payment, meaning the balance decreases, but the payment that you make always stays the same. That's why you see your mortgage rarely change. Now, the taxes and insurance may change, but the principal payment does not. Now, your TSPs are growing at compounded interest rates, meaning the money that you have invested in the CS&I, for example, are compounded returns. So if I was to compare a 4% mortgage to a 4% investment, even though they're the same rate, one is simple interest staying the same while the other is compounded interest. And this is why it's a case-by-case basis. Some families do need to pay off their mortgage and maybe take money out of their TSP if they're paying 7, 8, 9, 10% for any debt that's outstanding at retirement. But if it's under 5%, there's a good chance that over time you will beat a 5% return in the C fund, S fund, and I fund over time. So remember, pulling money out of your TSP stops the compounding effect and may leave you with less for retirement down the road.
Is there an impact to the mortgage interest with the decision of paying off your home with your TSP?
Yeah, as I alluded, if you have a low mortgage rate, which many families are not landlocked, but they're interest rate locked, right? They've got into a mortgage at 2%, 3%, 4%. If it's below 5%, your TSP investments should earn a better return over time if you are properly allocated. And this is the fun fact. 89% of borrowers today have a rate that's below 6%. 59% of borrowers have a rate that's below 4%, and it's making it a really tough call to pay off your mortgage early. Now, if we go back years ago where interest rates were potentially higher, then it made sense to pay off your mortgage. But with these locked in very low interest rates, it makes sense for often those families to keep that debt in retirement.
All right, so there certainly are tax implications that need to be considered. If someone makes the decision to withdraw that large lump sum from their TSP and pay off their home, what's the tax consequence?
Sure. So let's say this federal retiree takes out $150,000 out of their TSP. That's not what you actually get. You have to actually reduce the taxes out of that. So assuming a 24% effective tax rate, you'll need to withdraw $197,000 just to net $150,000. If your state taxes TSP withdrawals, that's another hit. And too many withdrawals actually increase your IRMAA penalties, and that could increase your Medicare Part B and D premiums for the next year that you're paying maybe $259 or $400 a month per person for your Medicare premiums, and that all could be avoided by layering over into multiple years that withdrawal to pay down your mortgage.
All right, Andrew, I know there's some people, watching along with us today, and they're saying, but Andrew, it's just gonna help me. Mentally, I need to get this done. So is there a way to minimize the tax burden if someone is just set on paying off their mortgage with their TSP?
Yeah, Bruce, I mean, we're not robots. This is an emotional thing. Like, it's nice to have the safety factor and confidence going into retirement that I don't have this debt that I still owe hanging over my head. So oftentimes what we'll help clients do, if this is something that's very important to their confidence in retirement, we'll look at not taking a lump sum from their TSP, but spreading those withdrawals over 2 years, or do a combination of taking money from the traditional TSP and some from the Roth TSP to keep them under a certain tax bracket. This strategy can prevent jumping into higher tax brackets, messing with your IRMAAs. If one of these years is post-retirement, your taxable income may be lower because you just retired, reducing that overall tax burden.
All right, so let's talk federal employees. I'm 58. No, I'm not a federal employee. My dad was. But let's say somebody 58 and they want to retire at 65. What about paying off the mortgage before I retire? Is there a benefit to that?
I think so. If you have more than 10 years before retirement and a mortgage rate that's above 6%, making extra payments on that mortgage can be really wise. While working, you have income and cash flow to absorb those extra payments. And by looking at your spending plan and making cuts to your standard of living to be able to free up margin to do that is really wise. A mortgage is a unique debt because you live in it. Unlike other assets and other debts like rental properties or a TSP loan, you actually live in this loan. So it's important to get that off of the balance sheet before retirement. I believe this approach shifts in retirement where income from investments is more critical than when you're still saving for retirement.
And certainly interest rate comes into play here, but what is your overall stance on paying off your home in retirement?
Certainly, most of my clients have their house paid off, they're debt-free, they have no debt, and I can see the difference that it looks like for their retirement and how it makes them feel. Being debt-free in retirement is a great goal, but it's not a one-size-fits-all answer. And sadly, many gurus and pundits will say everybody should be debt-free, and that's just not the case. You just don't want to be in debt. There's a difference between having debt and being in debt. So the decision should be based on individual factors like tax implications, investment returns, and cash flow needs. So it's crucial to work with a financial planner or a financial professional, especially one who understands both tax planning, retirement strategies, and your federal benefits.
Yeah, so this is, I think this last part, Andrew, is really, really key because you talked about, whether you're looking at the cookie cutter thing or the generalized advice that I can find on the internet. Why is it so important to get a personalized advice on your TSP, your retirement plan, and thinking of paying off a mortgage?
Well, your situation is just very unique. Many of our clients are going to retire earlier because of the special retirement supplement or because of their status as an LEO. And so your situation is different than your neighbors who may have the exact same house, similar mortgage, but your benefits, your TSP, your ability to withdraw it at different ages makes your situation unique compared to your neighbor. And so what I would encourage you to do is sit down with one of our financial planners or so where we can offer you a personalized retirement benefit report that shows you what your federal benefits are. We can go over your TSP allocations, make sure that you're prepared for retirement. So don't try to do a DIY six-figure financial decision by yourself. Work with a company that specializes in federal retirement benefits like our own. So if you want to schedule one of these one-on-one visits, all you have to do is click the link below. And if you have other retirement questions or questions about your federal benefits, shoot us an email because your question might become one of the videos that we have here on the channel. So again, thank you for listening to this video, and we'll see you next time on our next video. Have a blessed day.